Do you want to talk about? I like this one here because it's something that has to do with the economy, and you always kind of follow this one. I'm talking about Manpower, which does temporary employment. And generally, the thing has always been, I've been doing this for 40 years, over 40 years now, is that if they're busy, that means the economy is doing very well. But if they start slowing down, then businesses are saying, we really don't need any extra help, we're not really hiring, that's when they don't do as well. So let's take a look at Manpower. Can't forget the name or the symbol, it's MAN, M-A-N. They're in the staffing and employment services industry. No surprise to me here. The short is 11.7%. So there's other analysts who think that, yes, this is going down. We're going to short this stock because we think it's fallen. Unfortunately, they have no PE ratio, which means over the last year, no earnings. The industry was at 29.1. Price to sales, very low, 0.1 versus 0.3 for the industry. Price to book value is 0.8 versus 2.1. But I do want to point out the price to tangible book value is 51.3. So that means they have a lot of intangible assets on the balance sheet. You got to be careful of those because if things don't go well, they got to write those down. And they say, it's a non-cash write down, but it still takes down the value of that company. No earnings growth of last year. Sales are down 3% year over year. Now, the 5-year earnings per share estimate by the analyst does look pretty good. It's a 33.6%, but the industry is a negative 11.6%. They do have a nice yield of 4.4%, but remember, if they have no earnings, where's that money coming from? Are they borrowing that money? What are they doing? You want to be very careful when you see a payout ratio that's not material. Free cash flow payout ratio a negative 72.4. So that dividend, the other problem with that too is that dividend could be cut because they just don't have it. Business is slowing down, so be careful of that. I was kind of hoping this would be a buy, to be frank with you. On the balance sheet, current ratio 1 versus 1.4. That's okay. Debt to equity 0.9 versus 1.3. It's not too much debt, so they could weather a storm if one came along. We do see the net profit margin. Yeah, they're losing money. It's a very small amount. It's a minus 0.1%. The industry is a positive 1.2. Return on equity at minus 0.8%. Free cash flow a minus 70 versus 300 million for the industry. Just not very exciting here on this. I kind of thought maybe we'd find something good here, but it seems like a lot of people are not thinking they need temporary help right now.
Yeah, I was kind of surprised because last week after they reported earnings, the stock fell, it looks like about 7%, even after reporting better than expected results. It looks like they earned 83 cents per share. I know you said they had no earnings. Maybe that was earlier in the year. They had big losses to offset that. It wasn't a big beat. Analysts were looking for 81 cents, so again, 83, not hugely different. But the thing you look at is year to date, the stock is down 42%.
Oh, wow. I think that's why I thought, well, maybe there'd be something here.
Yeah. Over the last 5 years, it's down 52%. Over the last 10 years, it's down 63%. So, this stock has really, really been under pressure, to say the least.
You know, it's funny, over the years, I always kind of want to buy this company, but just never, the numbers never quite look good. I'm glad we didn't buy it down for a 5-year, 10-year. Gosh, never been a good investment, unfortunately.
No, there were times where it went up to like 100, but
Yeah.
it just kind of, you'd have to obviously time the market and get out at the right time, which we know is darn near impossible. And I'd be curious too, because it looks like they do offer, that recruitment services for permanent and temporary, but they also do offer some other services like assessment, upskilling, reskilling, career management, workforce consulting, and training and development services. So, I'd be curious what their revenue breakdown is, if it all just mainly comes from staffing or as companies are hiring them, again, in that consulting capacity to a larger degree. That might be safer revenue, less variable than that recruiting business.
And that's why before you invest in a company, we do read the conference calls, previous time frames, look pretty deep in the company, because you really want to understand what that company does. Because you mentioned some names, but how much revenue they get from it may be like 2% of everything. So you got to understand the business before you invest into it.
Yeah, and I'd be curious too with this whole HB1 visa situation where they're really lifting the price. It's like, would this actually help Manpower? Because our company is going to look for a consultant rather than bring in, outside help to pay. What's the fee? Like 100? I think it's like is it $100,000? Am I making that up?
For what? For
the visa? It's a one-time expense, I know, but
I'm not sure.
Yeah. I know it's a heftier expense than it used to be, where some companies, again, might look to alternative solutions. But anyways, let's look at the earnings going forward for Manpower. I mean, this looks decent here. I mean, you go out to December 2026, estimated earnings per share here, $3.82. You get a target sell price of $63.41. It trades at a forward PE under 9 times. But this is, again, where things get very interesting. I mean, year over year, earnings are expected to decline about 37% this year. Then next year, you're looking for earnings growth of 33%. I mean, is there some interesting accounting going on there to have such a large fall and then such a big gain in earnings per share, considering revenues estimated to be essentially flat this year and then up 3% next year with stable revenue? Why are earnings just all over the board?
And also, too, I did look at December 2026. So 90 days ago, they were looking for an estimate of 437. It's now dropped to 382. So they are bringing that estimate down. I think it might come down even further from that number. So,
I mean, you still got a buffer technically on the valuation, but
Yeah.
I still just wouldn't understand what happened this year to have such a large decline in the EPS.
yeah, I think the best time to probably buy Manpower is when you're in a recession.
Yeah.
Because when right now there's a lot of people working and so forth, if you start laying people off or slowing things down, you don't need temporary help. When you need them is when you come out of that recession, when you come out of that slowdown in the economy. So not the time to buy it, unfortunately, and the numbers just don't say buy it.
I mean, the target sell price says buy it, but the other
That's right.
situations
Yeah.
does.
I think I was looking at something to get
Yeah.
the target sell price. I'm not going to ask you what it was again
It
because
trades at under 9 times earnings. I'll give you that.
See, and this is why you got to be careful, kind of like a value trap.
Yeah.
Because those numbers, that sounds pretty good. That's why I tell people, you can't do this in 5 minutes and say, yes, I'm going to buy this company. You're going to miss things. And yes, the 9 times earnings sounds great, but there's so much more behind that number that if you're investing, you have to spend the time to understand what's behind that number. Let's talk about